Good afternoon, traders. Today's Monday, July 29th, 2013. Coming to you here from RJO Futures with Bob Haberkorn here, Joe Kobel, and John Caruso. We're here to discuss the numbers that are coming out this week. We got a full range of numbers. Friday, you got the job number coming out at 7:30 Central, bright and early. Wednesday, you got the GDP number, and then tomorrow you got the start of a two-day Fed meeting that'll announce what they're going to do with the rates and what their policy decision will be. So a lot of stuff on the table. Expect some market movements. Joe, what are you looking at this week with the equity markets?
Looking at this week, the SEP contract for the E-mini S&P, we got new all-time highs, 1695, very high level. Been range bound between 30 points or so, 1660, and again 1695. Again, past 2 weeks haven't really seen a whole lot of movement. Good 15, 20, 30-point ranges throughout the day. And we got again GDP coming out, non-farm payrolls on Friday, as well as manufacturing ISM numbers. If this doesn't move the market, then typically what is going to move the market? So expect again some kind of breezing through QE3 talk. I don't expect any tapering just quite yet. But we are getting closer, and any hints inside the verbiage is going to, obviously put some movement into this equity market. So,
yeah, I think the verbiage that you'll probably see this week will be pretty much status quo with what they've had for the last 2 years of their sessions, and I think what you'll see is probably the equities ultimately make a move to that 1700 level on the S&P. Like they've been flirting around that range. It's down a little today. We're trading around 1680. It got down to about 1673, I believe, last week. It looks to be kind of in a sideways pattern, but there is support down around 1673. And do look from the Fed, if they are very accommodating with what they say with QE continuing forward, or the bond asset purchasing, no change there. I think you'll see a pretty big jolt in the equity markets, because that's about the only thing right now that I see that's really holding this thing up as much as it is.
I agree. I think it's important to kind of point out, here we're sitting about 1680 on the S&P on the September contract. We are 130 points, 130 points off of that low that we saw Bernanke put in the June FOMC statement. We hit that low after he spoke fairly hawkish in terms of interest rates. Market didn't like seeing that. We sold off to about 1550, and since then he's delivered about a handful of speeches, and he's been very dovish on his tone of interest rates, which has created this rally to 1680 or 1695, which was the recent high. I think it's a tale of two Bernankes. What are we going to see? Are we going to see the dovish Ben Bernanke or the hawkish Ben Bernanke? I think some of it could have to do with how the GDP number comes out. If we get a number that misses big on GDP, I see him being a little more dovish on interest rates. If it comes out in line or better than expected, perhaps hawkish. And that's what's going to dictate the direction of the market moving forward. But I think it's important to point out that high that we saw back in June, that low that was created in June was put in by Ben Bernanke. The market sold off after the FOMC statement in June.
yeah, purely by the words of a tapering effect, and we saw what happened. This is obviously a major shelf for the equity markets, and the second that the market kind of realized that this is going to be pulled out, we had that major sell-off, retouched that 50-day moving average, broke back down below that even further, and obviously when rates started going higher, Bernanke had to do what he had to do to get that sentiment back.
And John, you touched on something too about GDP. With the GDP number that comes out Wednesday, they're expecting 1.1%.
Horrible number.
So if that comes out better than 1.1%, you could see a different Bernanke than what you'll see if it comes out at 1.1 or below 1.1. So it'll be interesting. In my opinion, I think we see the dovish Bernanke from here on out. His term's coming up. I don't think he wants to rock the boat going into the end of his reign at the Fed. So I think you'll see continuation of the accommodative policies that the Fed's push forward. What about currencies? What are you?
Well, now that you mentioned the dovish Bernanke, over his last couple of speeches, he has been very dovish, which has helped put in the bottom of the bond market. The 30 years and the 10s have been rising since his last two speeches. We've also seen the dollar, the U.S. dollar, decline pretty drastically. We put in a high a few weeks back at 84.96. Here we are sitting about 81.80. So the U.S. dollar, any talk of lower interest rates or a prolonged period of lower interest rates, the dollar doesn't like to hear that. And any talk of lower interest rates is something that you start to see a flight to safety, and you start to see the bond market start to creep back up. And that's what we've seen over the last couple of weeks. So what I think happens in currencies, I think Bernanke is dovish on Wednesday. I think we're going to see the dollar perhaps putting the bottom later on this week. I think the dollar will start to look at some of the more bullish fundamentals of the marketplace. You know, looking at the jobs number on Friday, if we get a good jobs number, I do think we will see the dollar rally based off of that. However, I think a key level to look for in the dollar right now is 81.57, which is the 200-day moving average on a continuation chart. I could see us probing that 81.30 level over the course of the next couple of days, just on fear alone, with people pulling some of their long bets off the table based on Bernanke being dovish.
And look for subtle hints inside the 30 and 10-year market, as well as the Japanese yen on those moves that John just mentioned as well. So.
Right. And for the gold, silver market right now, they did go up pretty quick here. We got above 1,300 pretty convincingly, and a lot of that was attributed to the comments Bernanke made at his Cambridge speech after last June's FOMC. But it does appear that they are pretty shaky right now, specifically in the gold market. I mean, it's up right now at 1330. It's trading around as of this video time. Got as high as 1338 in the overnight last night. Last week we saw a high to 1348. 1350 for all intensive purpose sakes. There really was no resistance all the way up there, but now we're starting to see some formation developing in the chart, and it does look like this market is very shaky for the bulls. You know, I've been very reluctant to add anything to new positions here. Actually, kind of looking at this thing, if it does trade down below the 13.25 level again here, I look for a further sell-off in this thing. You know, not necessarily just based off what the Fed or what the job numbers are coming out. I'm just looking at the pure technicals and the realities of this market right now. Unless there was some drastic change at the Fed on Wednesday, I don't see gold doing too much here this week. If anything, I see it pulling back here, maybe making another test at that 1,300 level. You know, you got two conflicting things going on even this morning in the gold market. You got hedge funds raising their bets here in gold, but then you get Goldman Sachs coming out in the early morning hours saying that they're looking for gold. They're bearish right now on that market. I'm bearish short term being a week and a half. Overall, though, I think September, as the summer wraps up here, I think you will see a renewed interest in the precious metal markets for the upside going into the end of the year. Because again, like I say, on almost every video we do here, nothing's changed from a geopolitical standpoint, and if anything, we're so stuck on what the Fed's doing right now at this moment with the market. I do think eventually you'll see gold, maybe going into the end of this year, will start acting again as the safe haven that it typically is. I know that's a pretty controversial topic, what gold is and what it does, but ultimately I think 5,000 years of history, gold will again prove again that it is a store of wealth as we continue into this unknown with the Fed and almost the phony market that we're seeing at this point.
Yeah, I agree with you almost 100% on all that. I mean, main thing to look out for. Very critical time. We've got a lot of consolidation, all the markets, metals, equities, everything across the board, minus the oil market. You're at the 50-day moving average. These are big technical levels. We're bound to see some big movement off of these numbers, whether we hit or miss or not. So.
Yeah, and then Friday, I don't think we've said, but they're expecting 175,000 rate to be at about 7.5, which I believe that would be about a point better. So we'll see how that comes out, how it affects the market. The job numbers haven't been too, they've been in line with the low expectations of what the market's already set forth. So there really hasn't been for the last round anything too sizable that's really moved the market on those numbers.
Yeah, I think unemployment, they call it the Goldilocks situation, where you get the unemployment, the job creation comes in line, the rate comes in typically in line to maybe a little bit better. But what it does is it just creates that sense that the Feds are going to continue to be there, which is why they call it the Goldilocks scenario for the
I think that's entirely accurate. I mean, look at these numbers here. I mean, we're putting up 185,000 jobs. We're going to want at least probably 2.25 to 500,000 added before we see any substantial real growth. We're expecting, second quarter GDP 1.1%. I mean, for the year, we're looking 2.3 to 2.5, and then 3 to 3.5 on next year. I mean, China 7%. You know, we're losing our mind over 7% growth in China. Look at these numbers what we're putting up here. I mean, you know, I think it's plain as day. We're here to stay with accommodative monetary policy, at least for a significant more amount of time.
All right. Well, if you guys, if you have any additional questions, or you'd like to talk a little more about the markets, feel free to contact any of us over here, Joe Kobel or John Caruso or myself, Bob Haberkorn. Would love to talk through these numbers with you. Remember, futures trading does pose significant risk. It's not suitable for all investors. And remember to follow us on social media at Facebook and also on Twitter.